Hello again, everyone. Today's section is section 12.2, and this is titled Payroll Deductions. And I need to start with some bad news. Just because you earned X dollars in gross pay does not mean that that's what you walk home with. There are many payroll deductions. These are amounts that have been withheld from your pay for various purposes. If they're taxes, they're the ones that are required by law. There are other types of payroll deductions that are voluntary or kind of sort of voluntary, depending on what they are and where you live. They could include medical insurance premiums, union dues, paying for your work uniform, investment in a retirement fund. So there's different levels of voluntary. The taxes, though, are always a requirement. The major income tax, the one that you typically hear about commonly in the springtime, is the federal income tax. Federal income tax statements are due to the federal government by April the 15th in most years. Federal income tax is also one of the more complicated ones to calculate because there are many little nuances to it. And so there are tables that we will refer to for our purposes here. An employer will estimate your federal tax liability based on what you have earned. There are a lot of nuances in the federal tax code that would increase or decrease your tax liability that your employer may not know about, involving things like paying tuition to a college, or rather not tuition, but student loan payments for college education, paying a mortgage. You may have had another job. The employer will make its best assumption as to what you owe and withhold that money appropriately. They forward that money to the Internal Revenue Service. What you actually owe, your actual tax liability, is not determined until you file your annual tax return. That's what happens before April 15th. And based on this, it may turn out that you break even. It may turn out that you owe the federal government some money. It may turn out that the federal government owes you money because of all of these various other factors, other variables that go into play here. So federal income tax is the only tax that we have that will require us to refer to a reference table, and we'll look at that shortly. But before we get there, let's talk about how your employer determines how much to withhold. When you begin a new job, your employer will have you fill out a form called a Form W-4. This is an IRS document on which the employee declares the number of withholding allowances. Typically, you get one for yourself, and you get one for everybody who is dependent upon you financially. So you as high school students would usually be answering this as 0. You are dependent upon your parents for food and shelter and clothing and all that whatnot. However, if you are the head of the household, let's say that your father is starting a new job, he would be entitled to have a withholding allowance, count one for himself, one for mom, if mom and dad are living together, or stepmom, as the case may be, or it's the 21st century, stepdad, as the case may be. One for every one of your, one for you, one for all of your minor siblings. Minor meaning that you are under the age of 18, or that you are over the age of 18, but you are still financially dependent on your parents. The more allowances that you have, the more allowances that you have, the less federal tax liability you have. The federal tax code gives you leeway, gives you back some, charges you less money if you have more dependents. So what happens is less tax gets withheld. So here's what a W-4 would look like. You'll notice at the top that we have a spot for the employee's name, Emily Cardo's social security number, her address on Main Street in Sacramento. There's a question about marital status. Yeah, unfortunately, it is true that the tax withholdings are different if you are single or if you are married. That does make a difference. Line 4 asks you how many allowances you are claiming. This is the big one. 0 allowances. Line 5 asks for an additional amount, if any you would like deducted. This would be if you are managing multiple jobs and you are trying to manipulate how much is being withheld so that you don't have a tax liability at the end of the year. There is an option in line 6 where under very, very certain, very specific rules you can claim that you are exempt from federal taxes. That's a rarity. And line 7 asks if you are a full-time student. That does not necessarily cause you to be automatically exempt, but it certainly does support the matter. You would sign it and date it, and your employer would fill out information at the bottom, and this would be kept. A copy of this would be kept on file with your employer, and a copy would go off to the federal government. So how do these tax tables work? Well, it's pretty simple. I've sent you separately a file that is essentially page 317 from the textbook, which is a tax table. Now, this is not the current tax table, obviously, but it'll work for our purposes. And the way the tax table is constructed, you'll see on the file that there's a section for single persons with a weekly payroll, and then below that there's married persons with a weekly payroll. These tables then get redefined for biweekly pay or for monthly pay or for semi-monthly pay, as the case may be. Again, those would in all those cases they'd be split between single and married people. The table is not difficult to interpret. You'll notice that over on the left-hand side, the first pair of columns are labeled if your wages are at least but less than. So that'll give you a dollar amount band to refer to. And then you'll see that the remaining columns, if you're withholding allowances, if you have 0 withholding allowances, or 1, or 2, or 3, or 4, all the way up to as many as 10. And what you would need to do is find which row represents your pay. So you would go down until you find the band that includes your pay, and then you would go across until you're in the column for the right number of withholding allowances. So we refer to Emily for calculating her federal tax liability. She has $243 in gross earnings. We settled that in the last video. If you missed it on her W-4, she had no withholding allowances. So let's figure out how much tax should be withheld this pay period. So the first thing you would do is go find the interval that includes $243, and that happens here for at least $240, but less than $250. So we're in this $240 to $250 band, and we'll go across the column for 0 withholding allowances, and we find that she should have $29 withheld in federal tax. These amounts are always in whole dollar amounts. There's not going to be a cents component to the federal tax liability. There will be quite possibly with any other tax or any other withholding, but for federal tax liability, I will guarantee you that it will be a whole dollar amount. In this case, it's a whole dollar amount of $29. Couple other federal taxes to be aware of: Social Security and Medicare, and together these are called the FICA taxes. FICA, if you are interested, stands for Federal Insurance Contributions Act, and this dates back to 1935. Social Security tax is designed as an old age pension as well as a disability pension. So grandma and grandpa and great-grandparents might be collecting Social Security payments each month. Maybe you know somebody who has been injured in the course of their work and is unable to work any longer, and they are receiving a Social Security payment as well. That's where the disability pension side of Social Security comes in. Social Security also pays a benefit to survivors of a deceased worker. Now, the way that we calculate the Social Security tax is pretty simple. We take the gross income and multiply it by 0.062, so that we are withholding 6.2% of the employee's gross income, and that is their Social Security tax. There is a little bit of a twist to this, though. Social Security withholdings stop after a certain maximum taxable annual salary for the year 2020. That's over $137,000. So once you get past $137,000 in gross earnings for the year, Social Security tax is no longer withheld. In all the problems that we look at, none of our employees will get anywhere close to that. So you don't need to worry about that. Medicare is health insurance for the elderly and the disabled. It supplements, it's a nice counterpart to Social Security in that this is the part that covers any medical costs. Withholding, again here, does not involve anything with the table. It's a strict percentage. We'll take the gross pay and multiply it by 0.0145. 1.45% of your gross pay is withheld for Medicare tax. Unlike Social Security, though, there is no maximum salary. So the more you earn, the more you are paying in Medicare tax. Let's give this knowledge a try. Again, here's Emily one more time. She has her $243 in gross earnings. We want to determine her FICA withholdings. That means we want to find how much is being withheld for Social Security, and we want to find out how much is being withheld for Medicare. So these tax amounts, all tax amounts, are rounded to the nearest penny. So we will go to 2 decimal places. To find Social Security withholding, we'll take the $243 that she earned, and we'll multiply that by 0.062, and we find that we get 15.066. We'll round that to the nearest penny, and we'll call that 15.07. And for Medicare, we'll take the $243 and multiply it by 0.0145. And this time around, we get 3.5235, says the calculator. We round to the nearest penny, that'll be $3.52. A very rough rule of thumb here is that the Social Security tax withholding should be about 4 times as large as the Medicare. It's not an exact rule. Don't just calculate Medicare and then multiply by 4. That won't get you the right number. But roughly speaking, Social Security is about 4 to 4.5 times as large as the Medicare tax. So if you are calculating Social Security and Medicare withholdings and you find that Medicare is larger than Social Security, that means something's gone wrong and you want to fix it. Some more withholdings that we should talk about. Many states charge an income tax, some do not. So that's why it's stated here that it varies by location. It could be as low as 0%. Those would be the states that don't charge it. It could be fairly high. In Pennsylvania, it's 3.07% of your gross earnings. So again, very easy to calculate. Cities, townships, boroughs, they also have the option to collect income taxes at the local level. That's usually 0.5% or 1% of your gross earnings. And on top of that, they can also charge what's called a local services tax, which is to finance local services such as the police and the ambulance and the fire company and so on. And that tax can be up to $52 per year. That's often withheld at the rate of $1 a week. As I said at the beginning, there are voluntary deductions or quote-unquote voluntary. You can put some air quotes around that. The employee may choose to have additional amounts withheld for various reasons. Perhaps the employee is a member of a union and needs to pay union dues. Perhaps there is a health insurance program available through the employer, which would require the employee to contribute towards the cost of that health insurance plan. You could be contributing to a retirement plan. We'll talk more about that in a minute. You could have charitable contributions withheld. You could be charged for your work uniform. The sky's the limit. There's many possible voluntary deductions, but these are the major ones. Now, as for retirement plans, one of the more common ones in the United States is what's called a 401k plan. And this is a plan in which the employee and the employer are both contributing, and the employer will match what the employee contributes up to a certain amount. And that contribution does not get taxed until it's withdrawn by the retiree. And that happens at the age of 59 and a half and above. If you're wondering why there's a half in there, I don't know the answer to that. It's probably somebody's compromise in Congress when this was set up years ago. But on a practical viewpoint, this is where it comes from. Let's say that Angelo's gross pay for the week is $644. If he's contributing $75 a week as his contribution to a 401k plan, then the tax withholding, the federal income tax withholding for that week is not based on him earning $644. It's based on him earning $644 minus $75, $569 that week. That $75 is not taxable until it's withdrawn, which won't be for many years, and that may put Angelo in a different tax bracket. So the tax benefit, there may be many facets of the tax benefit of doing this. That's it for this week's lesson. So thanks for watching, and I'll see you again next week.